You know the name Stanley Black Decker. I mean, it's an icon of American industry, a 180-year-old symbol of stability. But just recently, this titan stumbled, and I mean stumbled hard, facing a crisis that really shook it to its core. So what on earth happened? Let's break down the collapse, the comeback, and figure out if this legendary company is still a smart bet for the future. And to really get just how monumental this company is, let's start with this number, 149. That's how many years in a row Stanley Black Decker has paid a dividend to its shareholders. Just think about that for a second. We're talking through world wars, the Great Depression, you name it. That's not just a track record, that's a legacy. But even icons can stumble. And to really understand the crisis, you first have to grasp the sheer scale of this company. This isn't just a tool brand, it's an absolute industrial powerhouse. Its tools are on pretty much every construction site on the planet. I mean, just look at this portfolio. DeWalt, Craftsman, Stanley, these are all household names. And it's actually a pretty brilliant strategy. They target every single part of the market. DeWalt for the pros, Craftsman for the serious hobbyists, and Black & Decker for, the rest of us. It's how they became the biggest tool company in the world. And all that market leadership, well, it translated into legendary reliability for investors. For 58 straight years, the company actually increased its dividend. That gets you into the elite club of dividend kings, a title that's only for the most dependable companies out there. This was the absolute bedrock of their reputation. So, with a reputation like that, how did it all come crashing down? Well, it started with that massive pandemic-fueled DIY boom we all remember. But when the music suddenly stopped, the company found itself caught in a perfect storm of soaring inflation and demand that just vanished. And this timeline just shows you how dizzying it all was. In early 2021, they're riding high, demand is soaring. By the end of the year, they're posting record earnings. But just a few months later, by the middle of 2022, demand falls off a cliff. The whiplash was so bad they had to slash their earnings forecast by almost half, a move that absolutely stunned Wall Street. And here's what that drop looked like. Adjusted earnings per share just fell off a cliff, down by more than half in a single year. For a company that's known for being rock solid, a plunge like this doesn't just worry investors, it absolutely terrifies them. So what really went wrong? Well, they got caught completely flat-footed. They bet the DIY boom was going to last, and they built up a staggering $1.8 billion of extra inventory. When demand disappeared, they were left with warehouses packed with tools they couldn't sell, and that just crushed their profit margins. But this is where the story pivots. With the company deep in crisis, a new CEO took over in mid-2022, and he did not waste any time. He immediately launched a bold, aggressive plan to pull the company back from the brink. The plan was super clear and built on 3 pillars. First, a massive $2 billion cost-cutting mission. Second, a complete overhaul of their tangled, messy global supply chain. And third, a strategic pivot to get back to focusing on what they do best, making and selling tools. To make that happen, management started selling off other parts of the business, like their security division. That let them double down on their main engine, the tools and outdoor segment you see here, which drives almost 90% of all their revenue. It was a classic back-to-basics play. And they moved fast. By the middle of 2023, they had already hit $1.8 billion of their $2 billion cost-saving goal. This proved the plan wasn't just talk. It was a real aggressive turnaround that was already starting to steady the ship. Okay, so the turnaround is underway. But what gives Stanley Black Decker a real fighting chance for the long haul? Well, it all comes down to its competitive moat. Those built-in advantages that protect it from rivals, even when times get tough. And that moat is really built on 3 things. We've already talked about the iconic brands. That's number 1. Number 2 is its incredible global scale. Their tools are just everywhere. But that third one, ecosystem lock-in, that one might be the most powerful of all. Let me break this down real quick. Let's say you're a contractor and you buy a DeWalt drill. Now you own a DeWalt battery and a DeWalt charger. The next time you need a saw, are you really going to go buy a different brand and have to deal with a whole new battery system? No way. You're going to buy the DeWalt saw. That's ecosystem lock-in, and it is incredibly powerful for creating loyal, repeat customers. Okay, so we've seen the collapse, the comeback plan, and the company's core strengths. Now, let's bring it all together and weigh the bull case against the bear case. Is this turnaround story actually a compelling investment? And this really brings us to the core debate. The bulls, they see a turnaround that's already working, powered by those amazing brands at a solid dividend. But the bears, they see some pretty significant risks. What if the plan stalls? What if a big recession hits? Or what if fierce rivals like Milwaukee start eating into their recovery? This table really puts the journey ahead into perspective. You can see their goal is to get their gross margin back to that historic 35% level and get earnings back up over $5. They're definitely on the right path, but there's still a pretty big gap to close before they can declare victory. Which leaves us with this one final thought. For a company that has survived and thrived for almost 2 centuries, this recent crisis was a profound test. The real question for investors now is whether this whole painful reset has actually forged a stronger, leaner company, one whose biggest and most profitable chapter is still ahead.